The ill-fated hedging strategy that resulted in a multi-billion-dollar loss for JPMorgan Chase has drawn the anger of regulators and politicians. It's made investors skittish and weighed heavily on the bank's management. It's even had resonance here on home ground. So for a look at some of the strategies the JSE is putting in place after this debacle is Leila Fourie, Director of Post-Trade Services at the JSE. Hi, Leila.
Hi, David.
So, I remember when the last big crisis happened and people said, how could all these intelligent, educated, experienced people have got us into such a mess? And I suppose the answer was greed, and the answer was that things are going to run just a little bit longer. And of course there were instruments, derivative instruments, some of them so complicated that even the regulators didn't understand them, which partly got us into the mess. So before you talk about what the JSE is doing, what's your reading of how this can happen again?
Well, I think if you look at the JPMorgan case specifically, it's a very interesting case because it came off the back of a number of regulatory changes in the US, where the Dodd-Frank Act introduced this so-called Volcker rule. And the Volcker rule prohibits investment banks from trading on their own account. Now, interestingly, in the South African environment, this change has been equally well implemented, but not via hard draconian regulation, rather by capital that banks are having to hold against prop trading positions. And so off the back of this change in the US, there was obviously enormous debate between the banks and the regulators around whether prop trading and hedge fund hedging should be allowed. And as it so happens, the outcome was that there was unfortunately an incorrect position, and while it wasn't held as a proprietary speculative trade, it was in the bank's position and it was as a hedge trade. Could this happen in South Africa? Of course, trading involves, as you so rightly pointed out, as much risk as it does greed. And I think fear and greed are the two dynamics that often drive a crisis. And
well, I think just to stop you there, Leila, I mean, yes, that's the point, isn't it? The point is that fear and greed do take over, and that is precisely, yes, what we need regulators for, so that there's a safety net, that certain, yes, things can't happen. Interesting listening to the head of JPMorgan Chase in his explanation of this, and he said words to the effect of, we don't really know how this happened, but we messed up, which doesn't sound very a very adequate response. Yeah.
And unfortunately, in a trading situation, you have two counterparties, and one of them is going to trade at a profit, and the other, and that will be at the counterparty's loss. So, insofar as JPMorgan lost $2 billion, there was somebody sitting on the other side of that deal who gained as much. Yeah. And unfortunately, in the trading environment, you are going to have gains and losses. And the trick is to ensure that as far as possible, risk management processes are put in place to prohibit extreme positions and extremely enlarged positions. And in our South African context, our risk management in the banking environment is very well established. Our banks are extremely well capitalized, and the South African market is rated by the World Economic Forum as #1 in the world as far as regulation of capital markets goes. That would obviously be a collaborative
Leila,
achievement.
You're right about the banks, and it is a great source of pride for us, obviously, and it saved us from the worst of the last crisis. Let's move to the JSE and what they can do. And I suppose there's a bit of an ideological position here too, is that the JSE must do what it can, but it also can't take responsibility for the people who work through it for all their risk. I mean, you can't be a nanny.
Absolutely, and I think what's required is responsible risk-taking on all participants' parts. So what is the JSE doing to make a contribution to an improved and systemically healthy environment? We have a very strong and stringent process in place in our equities market whereby funds are segregated, so that avoids any risks of fraud. We have very, very deep and detailed surveillance of our trading members in the equity markets on an ongoing basis to safeguard against build-up of concentrations in very big positions. On the derivatives market, we have a central counterparty model, which effectively means that traders join and start to face off against the JSE. We require that traders take a post margin on a daily basis for movement of positions to ensure that they're adequately capitalized. And we also have a very well-oiled infrastructure with our clearing members. And the clearing members, in the form of many banks and well-capitalized entities, together with the JSE, are working to look at running specific stress tests to identify and provide an early warning system for potential defaults like the Lehman's situation, for example. And we're also doing quite a lot around liquidity management. And that is really just ensuring that if a crisis does occur, that we've got enough liquid assets between the JSE's default fund as well as all of the participating members to see us through that difficult period.
Well, that is Leila Fourie, who is at the JSE.